A very, very warm welcome to each one of you on this lovely, lovely Sunday evening. And thank you so much for joining in on a Sunday evening to know more about taxes. So we have with us today Mr. Naresh Kumar, who is an expert. I'm going to be telling you more about who he is and what he does a little later. But like we always do, before we begin, we have a little bit of a presentation on Moolah for 5 minutes. And after that, I'll introduce Mr. Naresh Kumar to all of you. And then I'll hand over the stage to him for him to take over. So a very, very warm welcome to all of you once again. So here we are. Again, introducing Moolah for Women to all of you. Moolah for Women is a platform for financial freedom for women, and it's by women. The whole ethos behind Moolah is that there is no more reason to fear, because Moolah is a platform that has specially been created for women, and it has a unique approach to make finance simple, fun, and jargon-free, so that the audience can very gently get introduced to the world of finance and start taking charge of their finances from a position of knowledge. Who's Moolah for? Moolah is for everyone, whether it's kids who want to learn important life skills early in life, whether it's for young adults who want to begin managing their money from the very beginning of their careers, for working professionals who are independent and want to get confident about managing their money, for homemakers who want to start feeling financially independent and start contributing to their families' well-being, for young women who want to be financially independent faster, for retired women who want to take care of their money, and for womenpreneurs who want to learn business finance. We have a tribe of over 1,000 women, and Moolah has impacted more than 4,000 people from across the world in its last 3.5 years. How has it impacted? It has shifted the mindset of people to make them feel more in charge, worthy, and deserving, empowering them to become equal stakeholders in financial decision-making, supporting them by making them a part of a community of like-minded women, and transforming them to become smarter, more confident, liberated, and happier. We've also impacted a number of children ranging from 8 to 25 years, increasing their understanding about money, starting them early, providing them an environment where they can easily and confidently ask questions, and empowering them to become independent adults where they can start managing their money effectively. We offer courses which are specifically designed for women. These are both the Finance Essentials course and the Finance Advanced courses. These are both 3-month courses which are delivered on WhatsApp and require only 2 to 5 minutes of your day on a daily basis. We have weekly live interactions on Zoom and also 3 masterclasses, one at the end of every month. And of course, there are monthly quizzes and many learning things which happen around the courses. By the end of the course, women shed away their fears and start feeling confident about managing their money. The Moolah courses are available in several options. There is the affordable option and the premium option. The premium option obviously has live interaction with me, which is under the Platinum and the Platinum Lite programs, and that's where you get maximum benefit. Of course, you can also enroll for the Silver and the Gold programs. What does it offer? Like I said, the Platinum and the Platinum Lite programs are the ones where we have live interaction with me every week, whereas the Silver and the Gold programs are where you get pre-recorded sessions of the masterclasses. We also do one-on-one coaching to accelerate your financial journey. And we also hold workshops and organize curated webinars and workshops for organizations and corporates and women-centric forums in case they are interested in learning and gaining knowledge about a particular topic. I'm Meeta Gupta. For all of you who do not know me, I'm a financial life coach. I'm the founder of Moolah for Women. I have over 30 years of experience, and I've worked in banks and corporates, and I'm passionate about financially empowering women. My co-founder, Ritu, is also here today. She also has an MBA has experience of over 30 years. She's also an organic farmer and an angel investor. And she's also equally passionate about empowering women across the globe. Ritu, you can say a hi to everyone if you're there.
Hi guys.
Thank you, Ritu. So every month, on the third Sunday of the month, we invite guest speakers to talk about various topics. These experts are from various industries, and they talk on topics related to finance, to mindsets, to business and entrepreneurship. We also do book reviews and economic awareness topics and topics on women empowerment. And we have, as a part of this exercise, we have Mr. Naresh today, who is going to be talking to us about taxes. We also, like I said, hold corporate events, and these are some of the organizations where we have conducted webinars and workshops in the past, and these are basically customized to suit the individual requirements of the organizations. We can curate programs for you on both business finance and personal finance topics, and these are some of the programs that we can talk about. And of course, if you are interested in some other programs. So yes, these are some of the topics: key finance terminologies, financial statements, capital structure, financial planning, budgeting, mutual funds, etc., etc. We also collaborate with trusted industry partners for you to start taking action after you have acquired the knowledge. And we have partnered with various financial advisors and legal experts for you to start taking charge. And you can reach out to us if you want trusted people to start taking action after you have acquired the knowledge through the Moolah courses. These are some of the things that the tribe members have said, that they feel more confident, more independent, they have gained knowledge, their understanding of money has increased, their sensibility around money has increased, and so they've started feeling more confident in starting to take their financial decisions on their own. So yes, if you wish to create impact, or if you wish to join the Moolah courses, you can email us at contact@moolahforwomen.com, or you can WhatsApp message me on this number. This is my personal number. We are located both in India as well as UAE, and our website is moolahforwomen.com. We are also available across social media under #MoolahForWomen. And our podcasts are called Moolah Talks. So you can feel free to access any of these social media content and enjoy the Moolah experience. And with that, thank you so much for listening to me today and for joining in today. And let me now very quickly introduce to you our guest speaker for today, Mr. Naresh Kumar. Hi, Naresh. Would love to have you on the screen. Thank you so much. Lovely to have you here today.
Hi.
Super awesome. So let me introduce Mr. Naresh Kumar to you. Mr. Naresh Kumar is the co-founder of Wealocity. You can see that written behind him. He's advising and managing investments of over 300 crores for high net worth individuals and select corporates. He has about 2 decades of experience in private banking, personal wealth management, personal financial planning, marketing and sales of insurance and other financial services. He has had experience of establishing frameworks in setting up regulatory compliance for insurance broking, portfolio management services, and ISO certification for financial service companies. Naresh is a certified investment advisor and research analyst with multiple industry relevant certifications in equity derivatives, licentiate from 3, insurance broking, securities operations, and risk management. He's regularly featured through writings on personal finance and markets in dailies like the Economic Times and the Times of India. He also teaches across B schools in finance. On the personal front, he's married to a gynecologist and who works in a government medical college, and they have a 10-year-old daughter. He's proficient in multiple languages and loves to learn new things with interests in long-distance running, cooking, reading, writing, and traveling. So over to you, Naresh, and it's really, really heartening to have you here on the Moolah webinar, and thank you so much. We are honored to have you here, and over to you.
Yeah, hi. Good evening, everyone again. Let me jump into the presentation right across.
Any views on why tax or what is tax? Simple.
So, yes, anyone who wants to unmute themselves or put it on the chat box, what is tax really?
In a one phrase, one word, what is tax? What actually, yeah.
Okay. For me, tax is something revenue generating for a government. government.
Right. So what
Okay,
Jyoti, tax is revenue
re-
generation for the government.
okay. It's income for government. Okay. What strikes in our mind when we say tax?
It's a
Feeling.
burden for us.
Okay.
The money that we have to pay the government for services that we receive. For example, the
That's
road
great.
tax or, various kind of services and whatever the government provides us with.
That's
This is
pretty,
wages.
yeah, that's pretty positive response. Happy to hear that.
Our hard-earned money being passed on mercilessly to the government.
Yeah. This is quite normal to feel. Yeah, good. So the word, unfortunately, when we mean by tax, yeah, the first sentence that comes as burden, it is, we use the word tax for various negative connotations than the positive implications that we actually enjoy. Yeah, it's a income for the government. Yes, for what? To avail certain services that the citizens can avail from the government. So basically, it's a two-way approach where we are funding the government and for which we are trying to extract value through various services. So there are times when I hear people saying, okay, it's my hard-earned money, I earned, and why should I pay? Yeah. So ideally, the government has facilitated for you to work at a place for the security, safety, the overall, when I'm talking from a larger angle, the army protecting the borders, then the various regulations or laws that govern the land, so that you can you can take care of your life and so can earn. Yeah, we do have various issues of or lack of service or maybe the it may not have met to our expectations or even to the standards of basic levels. But then the idea behind taxation is to ensure that the government or the governance is taken care of, so that the public could be with their or think about their goals and all. So there are two things that are certain in life. So they say it is because we are now alive. One is death, the other is tax. So you can't avoid tax as such. So one thing that we have to see, that we have seen multiple judgments across governments. Let us be not, across governments in the sense across countries or governments of across nations have extracted tax from even the dead people if there is a liability as per their laws and regulations. So you can't avoid tax. At best, what we can do is we can, take advantage of certain provisions that the law provides, so that we end up and saving on the outflow of the tax. And if you would like, if you observe in India, we have more indirect taxes, that is through GST and other, because we have a very low compliance, which of course has been changing in the last few years, where we have seen the direct taxation, that is through income tax, has been on the ascent. But otherwise, it's mostly people always try to skip or avoid paying the tax. But with the new systems in terms of the rules or even the integration of the approach, it's become easier for the government to track. So it's become difficult for citizens to avoid tax. But then here today we'll be talking about the various nitty-gritties of tax and what are the provisions that we have where we can save. And while saving the outflow from the tax, how do we use those saving opportunities to build towards our goal? So it's about aligning those your long-term goals or even your medium-term goals to tax saving. So how do we take that advantage? How do we try to achieve all these aspects, like achieve your goals, save tax, and also generate higher returns if possible? So again, returns are an outcome of the risk that we take. So we will discuss that in a bit, but these are the possibilities. So all the three aspects of which we can achieve through the mandatory savings that the government gives us through provisions.
So just to tell all of you that obviously there are two types of taxes. There are the direct taxes and the indirect taxes. Indirect taxes are taxes like the GST, the custom duties, and all the import duties. All those things are indirect taxes on which you have no control over. You have to pay it whenever GST is charged on your every time you purchase something, GST is charged. So those are things you can't do anything about. Today we are talking about direct taxes. Direct taxes is income tax, and how we can use various deductions and exemptions and opportunities available under the framework of the income tax to be able to minimize our taxes and maximize, like Naresh said, maximize our goals and reap high returns. So yes, Naresh, sorry.
Yeah. Thanks for the clarification. So so deductions and exemptions, like the word says deduct, where you get a subsidy on various aspects, and there is exemptions, which is you are exempt or that money is an exception. So in income tax, you would see the most of the rules or the laws are based on these two aspects. One is deductions, where you are provided various sections through which you can, out of your income, you can deduct to that limit towards that particular or specified need and reduce your tax. And there are certain clauses or laws or sections within the law which would allow you to completely exempt or remove that particular portion of your income from being taxed. This is the distinction between these two aspects. Yeah.
Right. So, ladies and guys, whoever is here, please, if you have any questions, please feel free to keep putting it in the chat box. We're going to be taking all the questions in the end. Just to very quickly summarize, deductions are things which can be deducted from your taxable income, and exemptions are income which are not eligible for taxes, right? So there are certain—
They're excluded, basically.
Right. So they're excluded from the tax bracket. So both these things are available under the Income Tax Act, and we're going to be going deeper into both of these today so that you can take advantage of them.
So first, whenever we talk about income tax, the one thing that troubles or complicates individuals is these slabs they have. I mean, it's even going before going into the exemptions or deductions, it is this tax slabs that itself is always confusing. So here I have just put it the current tax slabs and at what rate it is taxed. Of course, there is something called rebate, which will come to the next part. So, but first is it is very self-explanatory. Up to 3 lakhs for all individuals, it is zero taxation. And this is on the gross. Okay, so we will be looking at how it is calculated. And then we also have two regimes. Okay, one which was introduced in 2021, which is the new tax regime, which is considered automatically the choice if somebody has not explicitly opted for an old tax regime. Okay, and not to get confused, what is the difference here is, here the new tax regime talks about no forced savings. It is all it gives the choice for the individual whether he wants to opt various sections where we talked about deductions, exemptions that they want to seek out of their income, or just pay tax on flat after a threshold level, which we will be talking, which is the 7 lakhs is the threshold over which the taxation actually kicks in. While in the old regime, though it says up to 3 lakhs, there is another provision up to 5 lakhs, from 3 to 5 lakhs, whatever the tax amount or liability that comes, there is a waiver through a rebate if somebody falls up to 5 lakh rupees, up to 5 or up to or 5 or up to 5. And so whoever's income is in that. So when I meant by income, this is the taxable income. Net taxable income is up to 5 lakhs and below. Then the rebate comes in from 3 to 5 lakh, that 5%, which will show you what the amount actually is in the next slide.
Right. So just a little bit of to provide a little bit of clarity, Naresh has talked about two types of incomes. One is the gross income and one is the net income, right? And these tax rebates are things which are available as a part of your net income, right? Naresh, correct me if I'm wrong.
Yeah.
So, and we will be talking about what is gross income. So basically, gross income is the income you earn, and after you deduct various you take avail the various deductions, whatever you get is your net income, and the tax is generally on your net income, right? We will be talking more about it as we go along, but to right now understand that there are two regimes. The new tax regime got introduced in 2021. Under that, you are exempt up to 7 lakhs. And under the old regime, you're exempt up to 5 lakhs. You can choose the two regimes depending on what is suitable for you. And the new regime does not allow you to take any deductions or exemptions, whereas under the old regime, you can avail deductions and exemptions. Any questions or any thoughts at this point before we proceed? Anyone? Or we're good to go?
Yeah, and if one were to opt the new regime, they cannot go back to the old regime. So that is the also a catch. So
right.
You need to be aware. So which we will also show you an illustration where we will show you which regime is beneficial, how to make use of it is also we'll show you an illustration. So I was talking about rebate. So in the earlier slide, we were talking about up to 3 lakhs, it is nil tax, and 3 to 6 lakhs is the first slab, which is about 5%. But here and then we also talked about rebate up to the 5 lakh income. So up to the 5 lakh income, so there is a rebate of 12,500, which is equal to the tax liability if somebody were to earn 5 lakh rupees. That is the up to 5 lakh. So the 5 lakh rupees up to 5 lakh, the maximum outflow as a taxation would be 12,500, for which there is a rebate provided by the government. So if somebody were to have the tax liability at 12,500, then their actual outflow would be 0 because it is nullified with the rebate. And if it is in the new regime, it is 7 lakhs. So they have rebate 87 years, for which they get up to 25,000. Sorry. So this is the illustration I was talking about. So here, what I have done is I have put it 5 lakh, 7 lakh, and 8 lakh. I'll just tell you how the 5 lakh is for the old regime, and 7 lakh is for the new regime, and 8 lakh again we'll be considering how this rebate kicks in for the new regime. So if you were to see, there is a basic exemption limit which is 3 lakhs, which is common across. Up to 3 lakhs nil. That is what the first slide which we talked about. From 3 to 5 lakhs, 3 to 6 lakhs, it is 5% taxation. So for the individual here at 5 lakh rupees, it is the tax payable is 5% of the 2 lakhs, which is coming to 10,000. So the ideal tax liability is 10,000, but because of the rebate up to 12,500, which is under that, so the individual need not pay any tax. Similarly, when it comes to the 7 lakh under the new regime, where there are no deductions or exemptions claimed, the slab wise income exemption is up to 3 lakhs, and the next 3 lakhs is actually 3 to 6 and 6 to 7. So there are two stretches. 3 to 6 is 3 to 6 is 3 lakh rupees, or which 5% is actually translates to about 15,000, and next 6 to 7 is 10%. So 1 lakh rupees, 10% of 1 lakh is 10,000, which cumulates to 25,000 rupees. So here,
Just a little, if I can just
yeah,
go back to all
go
of
back to the,
for you to understand. If you
Yeah,
see
yeah.
that the slab system, what it basically means that if you are earning an income of, let's assume 9 lakhs, you will not pay 10% on the full 9 lakhs. If you would have paid 10% on the full 9 lakhs, you would have had to pay 90,000 as your taxes, right? However, the amount of tax, the way it's calculated, because it's a slab system, on the first 3 lakhs out of your 9 lakhs, you pay nil taxes. Okay, so the first 3 lakhs out of the 9 lakhs, you've not paid anything. For the next 3 lakhs out of your 9 lakhs, you pay at the rate of 5%. So 3 lakhs, when you pay 5%, it's 15,000, right? Because 5% of 3 lakhs is 15,000. And on the next 3 lakhs out of your 9 lakhs, you pay 10,000. So on the next 3 lakhs, you pay 30,000, right? So 30,000 plus, and in this case, because the example that Naresh has taken is that the income was 7 lakhs. So on that 1 lakh extra, you will pay 10,000 here. So that 10,000 becomes on the 1 lakh extra above the 6 lakhs. So the amount of total taxes you pay is 15,000 plus 10,000, which is 25,000, which is the number which is appearing here. The 25,000 is the tax payable. However, because of this rebate which is available of 25,000 under the new tax regime, you again become eligible not to pay any tax. Sorry.
So yeah. So there is one catch here: the income, your taxable income, should not go past 7 lakhs to enjoy the benefit. Say in the next example where we are showing a 8 lakh, here we have shown the rebate is 0, because the rebate will not kick in if the taxation goes beyond the threshold. I mean, your taxable income goes beyond the threshold, that is beyond the 7 lakh. So once it goes beyond 7 lakhs, all the rebates will not be coming into picture. So then the tax liability is directly transferred to 35,000. So there is no up to 25, and there is no slab system there. It is right across. That's the reason I said it should be 5 lakhs or less in the old regime, 7 lakhs or less in the new regime. If it goes past the 7 lakhs, then the tax liability, there won't be any rebate through any rebate or subsidy as a rebate for the individual. So that is where it goes, and then add the health and education cess at 4% above the 35,000, which translates to 36,400 net tax liability for the individual.
So this 4% is on the tax payable. So 4% of 35,000 is 1,400, and that's why the total tax payable is 36,400.
So if I could ask you a question, Naresh, on the previous slide.
Yes, please.
So you are saying, so what I'm trying to understand here is that the slab rate is common for both the regimes, and the slab is applicable on the net income, for that net taxable income. And here you are saying is if you choose the old regime up to 5 lakhs, if your taxable income is, then you get a rebate of up to 12,000, whatever, 12,500. And if you are choosing the new regime, then up to 7 lakhs taxable income, you get a final rebate of up to 25,000. The moment you hit amount above 5 lakhs in the old regime and above 7 lakhs in the new regime, you are not liable for any, you cannot avail of any rebate.
True.
Then the entire amount will get taxed as per the slabs.
Yes.
Okay. So how does one decide which regime one should stay with? The old
Yeah,
regime
so
or the new regime?
that we will come into the next
Okay.
few slides. We'll just explain
All right.
how
All
we
right.
can. We'll first know which are those deductions to avail. So it's first thing what we'll have to look at is there is no single formula to arrive at which regime or which ones to. So that's the reason we have to understand the individual's status in terms of what the provisions that they can possibly use, and if they can avail the full extent of that, what is the tax liability in that case?
So one
So
thing,
which we will.
if I can say here is that the first, if you remember what Naresh said, is that if you have started availing the new, paying tax under the new tax regime, then you cannot go back to the old tax regime. So first of all, also check with your chartered accountants, because all of you must be already filing taxes every year. So check out with your chartered accountant whether it's you're filing your taxes under the old tax regime or the new tax regime. If you're under the old tax regime, then you can opt for the new tax regime. But if you're in the new tax regime, you cannot go back to the old tax regime, right? So it's very important for, first of all, knowing whether you are eligible to go back to, you may think that, oh, I want to go to the old tax regime because I want to use that. But it might happen that you can't, because already you are availing of the new tax regime. Okay, Abha, you had a question. Have you clarified it, or do you have any other questions on that? Your question was, can you explain what is rebate and what are the few things we get rebate on?
Yeah.
Abha?
Yes, absolutely.
Okay.
Okay,
Perfect.
so there is no conditions other than this. So the rebate is in the old regime, anything less than 5 lakh. And in the new regime, anything less than 7 lakhs. 7 or less than 7, 5 or less than 5, respectively for new and old regimes.
And you pay
So that
more.
even 1 rupee additional to the 5 lakh or 7 lakh, the benefit ceases to exist. Then we have various sections. So we have earlier we used to have ATC, ATCC, ATCCC. Even now you will be seeing all those things, but they are all clubbed together to the broader section ATC, which I'll also show you in the next few slides. But that is deductions on investments. I'll just tell what all there's a huge list of things that you can claim, but the limit that one can claim under these ATC is 1.5 lakhs. And you have national pension scheme. This is okay. Each of these are in addition to each section has a validity for depending on the possibility of whether they can claim or not. Okay, so you can claim all of these if somebody is eligible for. So there is no exclusive, mutual exclusion like ATC. If I claim, I cannot claim ATCCD. That is not what I'm here trying to tell you. So you can directly avail every of these if a person is eligible for that. So ATC is basically your list of various investments that is approved by the government that you could do for your savings, which can also be claimed for your tax deduction. So the amount that you pay towards any of these particular savings or investments will be categorized as tax. To that extent, to the extent of 1.5 lakhs in your income will be not non-taxable or treated non-taxable. Then you have ATCCD, which is National Pension Scheme. This was introduced in 2004 for central government employees and subsequently been opened for all the citizens of India, and one can avail this. Of course, I'll go a little bit into the National Pension Scheme. It is locked in. Whatever the amount that you contribute is locked in till age 60, and at age 60 it translates into annuity. That is, as a pension one can withdraw. Of course, there are further exemptions given to withdraw the amount. So up to 70% can be withdrawn for various purposes like children's education, children's marriage, or even house construction. So, but there is a set process, and what is the limits and all is again specified. And then you have 80D, that is towards insurance, health insurance or medical insurance premium. The amount that is contributed for individuals, it is 25,000. For dependent parents, it is 50,000. So somebody can contribute up to that limit and claim that benefit. 80E is for higher education loan, and the interest that is accrued on the higher education loan can be claimed as tax exempt from their income. And 80G is donations. Again, there are two provisions within the donations. Certain institutions offer 100%, or they are allowed to offer 100% of what you contribute as tax exempt, and certain only up to 50% of their of the contribution is treated as tax exempt. But the limit here is how much one can contribute is 10% of your total taxable income. So we'll just I'll detail it a little into the next slides, but I just wanted to give you the limits. And deduction for individual disability, again, there is two types of disability, or the extent of disability. So based on that, up to 75,000 in the lower disability, up to 40%, if I'm not wrong, and 1.25 lakhs per annum if the disability is higher than 40%. And the interest earned through various deposits, that is fixed deposit, recurring deposits, or even your savings account, the limit is up to 10,000 per annum for the individuals less than 60 years, and up to 50,000 for those beyond 60 years. In the next coming slides, we'll describe more in detail what these sections are and which are all the investment opportunities or saving avenues is what. So next slide. So ATC, the investments that one can consider is into the provident fund. It could be public providence, that is PPF, employee provident fund, that is EPF, and life insurance premiums, that is towards LIC or similar insurance products. Then the NSC bonds, that is National Savings Schemes, or Kisan Vikas Patra, or any other small savings schemes that is provided by the Indian government. And then children tuition fees, not the capitation and other admission fees, only the tuition fee also can be claimed. And then principal repayment of housing loan. Okay, here the new regulations state only for one house it is allowed. Earlier there were multiple houses, but it is only for one house. The principal repayment, whatever out of the EMI, what is the principal repayment part can also be considered. ULIPs, which is again similar to what I mean, they are an extension of the insurance products. Then savings into Sukanya Samriddhi scheme, that is for the girl child, which was launched in 2014. So that is one thing one could explore. ELSS, that is mutual funds, which are logged in for 3 years for this purpose of tax saving. And any investments that is towards annuities or pension plans, that also can be claimed under the ATC. So earlier it used to be a different section, which I have mentioned in the bottom, ATCCC, and that is also has been merged to ATC now. And bank fixed deposits for up to 5 years, but you need to ask the bank if you are availing this particular thing. You have to mention that the bank deposit when you're doing, it's not for 5-year thing, but it is for the purpose of tax saving, and then you would receive a receipt for that, and the money cannot be moved. Unlike other fixed deposit, you cannot touch before the maturity, that is before 5 years. And then senior citizen savings scheme, there is additional, it is also similar to a fixed deposit for senior citizens, and subscription to notified securities and deposits if whatever the government comes in between. And again, these are all now defunct, like contributions to UTI and those funds, but which is now part of the ELSS. And yeah, so subscription to home loan account scheme of national housing. These are the various avenues one can look at from for the ATC, which is up to 1.5 lakhs. So 80CCC is also combined into ATC now, so that is also falling into that. And ATCC D1, which is employer's contribution to NPS, is also part of the 1.5 lakh. So that is also is considered. ATCC D2 is something where the employer contributes to your to the NPS. Here, the maximum limit is 10% of the basic. So this is something which I would encourage most of the salaried people to explore, where, of course, it has to be facilitated by the employer. Like your PF, you will have an option to allow, or if some of you, if I don't know if you are aware of voluntary PF, that is voluntarily you can also contribute to your PF other than your employee deducted PF. Similarly, you can ask for the employer to deduct up to 10% of your basic as towards your NPS account. So here what happens is your income itself will come down. Your take home comes down because like your PF, this also gets deducted at source. So to that extent, you can also save. This is the limit here is 10% of your basic. That needs to be checked at. Anything above which will not be considered for taxation, though you can contribute for NPS. And there is an additional section which we talked about, ATCC D, which is 50,000 towards NPS. This is not, don't get confused with the CCD 1 or 2. This is a separate section, irrespective of your employer allowing you to contribute or employer deducting for NPS. You can yourself avail up to 50,000 rupees if you would contribute towards NPS. This is other than the 1.5 lakhs of ATC. This is the additional 50,000 that every individual can explore, irrespective of whether they are salaried, business, profession, anything. Any income taxpayer can use this. Then is the interest income savings on, tax savings up to 10,000 on your savings or FD for those individuals less than 60 years.
Right. So if I can just reiterate a few things out here, that the NPS, which is the National Pension Scheme, which is under 80CC D1 and 80CC D2, are all a part of this 1,50,000. Okay, that means that all this is, that's the maximum you can contribute towards your, and that will be exempt from tax. This is an additional one. The CCD 1B is the National Pension Scheme, which is an additional 50,000. So if you are contributing towards your National Pension Scheme separately, you can do another investment of 50,000. So the total investment now can be 1,50,000 plus 50,000, which will be exempt from taxes. Which can be deducted from your taxes. Okay, and the other one is your savings account. Savings account also includes your fixed deposit. So if you are getting any interest on your fixed deposits, if you see when the bank does TDS, it also deducts tax after 10,000. So up to 10,000 rupees, you are eligible not to. If you're getting interest up to 10,000, that is not eligible for taxes.
Yeah, here one more clarification. The 10% contribution to NPS is beyond this 2 lakhs. Okay. Because it is straight away. Yeah, it is. No, it is not. It is employer's contribution, but upon your willingness or after you give the willingness, why it is not considered into the tax, because it is not even seen as your income, because your income itself will come down to that extent. So that is something, but it has to be facilitated by the employer, like how they do it for your PF. And regarding the savings account or interest income, they generally don't keep the 10,000 limit or something until you explicitly go and mention or submit 15G or H, depending on the age form. They would deduct TDS mostly. So whenever we are trying to redeem, they deduct straight TDS.
Okay, because okay, I thought that they did that 10,000 beyond the 10,000 only there, but probably they don't come to know about it, and that onus is on us and not on them.
Yeah, because it is per PAN, right? You can have
Right.
multiple accounts, they will not be aware. So each bank doesn't collude across the banks.
Right.
So then is exemption of interest. Yeah, this is for individuals higher than 60 years. So that is up to 50,000. Then you have HRA component. Yeah, this is something again a little bit tricky in terms of how it is calculated. Most individuals, especially salaried, you have the HRA. Here, the rent is the least of the three conditions. One is the actual rent minus 10% of your basic, and 5,000 per month. Again, when I meant by 5,000, it is again dependent on what is the actual HRA mentioned in that sheet. At that point of time, it was 5,000, so it just came. And next is 25% of your total income. So here, earlier you had the 40% for metros, or 50% for metros and 40% for non-metros and all. But that is, so the condition here is the least of the three. So some people generally they have, say, for example, there is a for the sake of discussion, 5,000 as HRA. That is as per the payslip. 5,000 is allowed. Up to 5,000 is what is mentioned in HRA as 5,000, and the person is actually paying 5,000. His actual rent is also 5,000, and his or her basic is say 10,000. So in this case, what will happen is, say if it is a non-metro, 40% of basic is considered as one condition. Actual rent paid minus 10% of the basic, and the HRA declared.
I think you know what, Naresh, let's not confuse them. I think what we want to really say here is, first of all, HRA is house rent allowance. Okay, this is generally a part of your salary. When you negotiate your salary, there's a basic salary, there's house rent allowance, and there are various allowances. Okay, the house rent allowance is a part of it is deductible, which means that if you are getting some amount of salary as HRA, then there is some amount of deduction available, and there is a way to calculate it. Okay, so there are certain limits which have been given by the income tax, and the least of those limits out of your HRA can be availed as deduction, and you do not have to pay tax on it. Now, you do not have to go into those details. Your chartered accountant can go into those details and find that out very quickly for you. All you need to do is tell your chartered accountant that you have an HRA of this much and you're paying a rent of this much. Okay, so those are the two numbers that you need to provide to your tax consultant, whoever is filing your tax, and he'll be able to very quickly find out your HRA. So let's get on to the other provisions. Considering we are short on time, we are already close to 7:30. These are the other allowances. We'll not get into how they are calculated, but all we want you to know is that there are all these allowances, and as individuals, you should be aware that you can avail deductions under these allowances. So you have if you've taken an education loan, then the interest on the education loan, you can avail a deduction. If you have a first home, then if you've taken a home loan against your first home, then you're eligible for a deduction of interest on that. If you've taken medical insurance, again, you can, for your parents or yourself, you can avail take some tax advantages because of that. We've talked about disability. If you have disability, you can again take certain exemptions under that, deduction under that. If you have medical expenditures, again, there are certain eligibilities. This one, ATUs, again, for people suffering disabilities. 80 GGB is for people who are contributing to political parties. I think none of us are contributing to political parties as companies or individuals, so we will ignore that. And deductions on income by royalty to a patent of a patent. So if you're paying some patent, so what we are only trying to say, you can take a screenshot of these pages and see that what are the deductions that you can be eligible for. And here the exercise is only for you to gain more insight and knowledge on the kinds of exemptions and deductions which are available under the income tax, so that you can talk to your chartered accountant while you are filing your tax returns, that he can take advantages of these for you. Sorry, yes, please.
Yeah. So again, on these exemptions, we talked about what is old and new. So in old, you can avail all these deductions. But in new regime, as I said, it is voluntary. It's no more that the government says, okay, if you save on this, so you can avail these exemptions. So all that, if you make a comparison against new and old, it is the deductions on employer contribution. That is what I said, 10% of your basic, where the employer directly deducts, and the standard deduction, which is 50,000. So accepting these two things, the new regime actually doesn't allow any kind of exemption or deduction.
Right. So what we are trying to say here is that if you are paying tax under the new tax regime, government says, if you want to invest, that's your problem. Okay, we are giving you higher eligibilities, like Naresh just said, that under the new tax regime, up to 7 lakh rupees are exempt from tax, right? Up to 7 lakhs, you can claim a rebate and you are exempt from tax. So the government says, whatever you want to invest, it's your problem. Up to 7 lakh rupees, I'm not going to charge you any tax, after which I'll start charging you tax. Under the old regime, they say, okay, we're giving you a lesser eligibility of the slabs, but we are giving you advantages in other ways, that you can start investing in these forums. You can invest 1,50,000 under ATC. You can invest under various, all these, the HRs. You can take all these benefits. But on your, once your taxable salary is calculated, up to 5 lakhs, you're going to be not charged any tax. But beyond that, we will be charging you tax under the, as per the tax slab rate. So, yes, please, Naresh. Thank you.
Yeah, so I just wanted to show you this again, a graphical representation, because we were talking about what is the difference, how it will make a difference. But I think in the next slide, we can see the illustration actually. So you can move on to next slide. It's only a distribution which I gave.
So very quickly, if you see that the under the old regime, that 30% tax kicks in at 10 lakhs. Right, because they're giving you various deductions, so they're charging you a higher tax rate. Whereas in the new,
and you also have you have multiple slabs for you to take advantage. Yeah.
Right. So in the old tax regime, there are only 3 slabs, whereas in the new tax regime, there are higher number of slabs also, and the amount that you get taxed on is up to 15 lakhs. So you've given a higher amount, up to which, after which only the 30% tax slab kicks in.
Even your 20% actually starts after 12 lakhs in the new regime.
Right.
Yeah,
so basically, they're saying that we'll give you, we'll charge lesser tax, but we're not going to give you any deductions under the new tax regime.
True. So that is what it translates to. So in the old regime, for a 10 lakh, the tax liability is 20,000, but for in the new regime, it is 54,000, which is higher outflow. But if you move towards, if you were to check here, how I had come with this particular thing is, we have assumed that the individual has completely exhausted their 1.5 lakhs of ATC and 15,000 under ATD and 50,000 under NPS, and then 2 lakh of exemption on interest towards first house. So if somebody has all these things, or who are trying to utilize all these exemptions or deductions, then they would be having a higher benefit in the old regime. So because somebody was asking which was which is beneficial, the new or old. If somebody is utilizing the maximum deductions, then they end up having benefit in the old regime. But you have to also keep in mind that you cannot always hit the interest 2 lakh every year, because the interest goes reducing after a period of time. So somewhere over a period of time there, so if you are not utilizing the various sections, then new tax regime could be beneficial, because you are not forced to save just to save tax.
Right. So just to again re-emphasize that, first of all, understand this old tax regime, these rates, these taxes amounts are after the fact that all these deductions have been utilized. If you're not using these deductions, then you may as well use the new tax regime, because the old tax regime will be expensive for you. But if
It's
you
because
use
4,15,000 has been utilized for various purposes as tax saving. After that is what these old regime numbers. Please understand that. Yeah.
So if you're not saving under any of these, or you're not making these investments, then it makes sense for you to go for the new tax regime, because then it will be advantageous for you, because the tax slabs are lower, and the 30% tax slabs kicks in only after 15 lakhs. Okay.
So there are taxation. One is income tax, which we just discussed. Then there is other income, that is through dividends, where you invest in stocks or mutual funds. And there is interest income, which we talked about, the various exemptions, and annuity or pension that you end up. The other is capital gains. That is when you sell property. It could be financial instrument like something like a mutual fund or stock, or even a bond, or even a property. Whenever you sell a physical property, the gains will be considered as capital gains. So this has a different taxation altogether.
So
this is not, this doesn't the capital gains, as the name says, this doesn't get added as your income, but it has a different tax slabs and different tax limits, which I mean, this discussion will not get into that.
right. So income tax is only charged on your salary, your business income, your dividend income, your interest income, your annuity pension income. All these things get clubbed into the income tax and are charged as per the slabs. Capital gains is on the things that you own. So if you own shares, if you own bonds, if you own property, all those things, when you sell those properties, or when you sell your shares, or when you sell your bonds, then whatever gain you get, that is your charged as your income under the tax slabs. That's charged separately under the capital gains tax. Okay, so don't confuse the two. Your income tax only takes care of your everyday incomes, which are coming out of your dividend, interest, salary, and everything else. Whereas your capital gains is when you sell your big assets which you own. I own mutual funds. Now I'm selling my mutual funds. I could gain, if I make some money, it'll get charged under the capital gains tax. If I've got a property, I'm selling my property, it'll get charged under the capital gains tax. It will not get charged under the income tax. And today we are only talking about income tax, because that's what you have to do at the end of
so even any lotteries or anything which is beyond 10,000 will also be considered as other income and taxed as income for that year. And you have to see that capital gains is only when, like Meeta mentioned, when you sell an existing asset or property or something, only then it comes, and it happens only when you are doing the transaction. Income is whenever you are making making money is considered as income. Yeah. So there are various tax saving investments which we talked about, ATC. But I just wanted to depict this because what I perceive as risk may not be the same. So in this, I just wanted to show you the hierarchy of risk on each of the tax savings that are available. We talked about PF, PPF, FD, Sukanya Samruddhi, which is more or less they are guaranteed products. And then you move towards capital guaranteed plans like some of the traditional insurance and all. And then ULIPs, these are all qualified under your ATC section. And then ELSS, that is mutual funds, which are logged in for 3 years. they are within this spectrum. This is the highest in terms of risk, but possibly higher return. And on the lower side, like your small saving schemes and all, which has a lower interest but also lower risk. They are more or less guaranteed.
Right. So
So I just
I think
wanted to depict.
everyone who is a Moolah, who's been through Moolah will understand that there are different risks associated. Some are debt instruments, some are equity instruments, and debt instruments are less risky, so they offer lesser return, whereas equity instruments are more risky and they could offer better returns, but you could also lose your money. But all these kind of investment instruments are categorized under the ATC, so that 1,50,000 that you can invest in any of these instruments. But you have to be aware that they carry different risks, and so the returns could be different. You could lose your money. Suppose one person has put all their money in PPF and the other person has put in all the 1,50,000 in equity linked saving scheme. The outcome could be totally different for the two sets of people who have both invested their money for tax saving purposes in these investment instruments.
Yeah, but both will get the tax saving benefit for that year, but the returns, it will be, like she said, the outcome is quite different. Yeah. So coming to, you have multiple ITRs, the tax returns. So one is you declare in your organization that you would be saving and all. The other is you submit whether you have done as per the savings. And then before July 31st, you have to submit the returns. I mean, you file your taxes. So when you file your taxes, you just go through certain process. So here we are just talking about ITR. One is for salaried pension, and basically you have no other income, whichever is other than straight income. That is other than the dividend, other incomes in terms of dividend and salary. So that would be categorized as ITR 1. In ITR 2, in addition to those incomes that you have mentioned, if there is any capital gains, then ITR 2 is the first thing. And if there is any foreign income, and that also will be part of the ITR 2. In ITR 3, every income which is categorized in ITR 2 will be considered. But if you also have a business or professional income, then you would have to consider ITR 3. The other set, because I have seen the new generation dabble in cryptos, they are also will be considered as ITR 3. So this is what generally most of the people will go up till ITR 4, where they are resident individuals and also have HUF income. So Hindu undivided family, there they will be considering for ITR 4.
Right. So generally the question is which ITR forms should we file, because there are various kind of forms. So most people who are salaried people, it's ITR form is the easiest form to fill. It's only for salaried people. So for most people who are salaried, you can file an ITR 1. But however, if you have business income or you have capital gains or other kinds of income, then you will have to choose another form, which depends on what your kind of incomes are. With that,
So,
I think we close the presentation on income tax. We'd love for you to ask your questions. We we'll very quickly tell you about what we are offering also as a part of Moolah. So if you can continue to stay with us for another 10 minutes, we will take these questions from all of you after we've talked a little bit about what all you can expect from the Moolah institution. Yeah.
So generally, when we talk about financial instruments or avenues, there is an understanding that there is a hidden interest for the other side of the person. So this is where we are talking about unbiased advice, because we open up what is our income streams, how we make income, or how we suggest particular things. So mostly the advice is from seasoned professionals who have a long experience in the industry, and we are compliant with the regulations of like IRDA, SEBI, RBI, kind of all the regulators. And the most important part is we are focused on goal-based financial planning. So whether we don't differentiate any investment avenue unless and until it suits you. So whether it suits you or not is the first criteria, that how we make a recommendations based upon the risk profile and the timelines and the goals. So that is what is a differentiating factor that we offer to our clients or investors. And we service across the geographies, and we are compliant across multiple locations in terms of regulations and laws. Yeah.
So,
And yeah.
Can I take over from here,
Yeah,
Naresh?
please. Yeah.
So,
Yeah.
So as a part of Moolah, what we are now offering all of you is that if you are a part of the Moolah course now, in the future, then we offer you a one-on-one exploratory session with Naresh and his team. Naresh is a part of, like I told you, Wealocity, which is a company which is into financial planning and advisory and asset management. So all your portfolio, they help you not only curate your portfolio and understand your portfolio, they also help you in managing your assets and depending on what your requirements are, right? So we have collaborated with Wealocity, and as a part of that, we offer you one exploratory session, one-on-one, which is a free session if you are a part of the 3 months Finance Essentials course now. After that, in case you are interested, you can avail of a financial, an individual financial planning and investment advisory for your own portfolio or your family's portfolio. The charges for that is only 25,000 rupees for a full year, which will, and once you've taken that, you will not only be planning your finances for you, but helping you with your goal setting, your retirement planning, saying, oh, I want 1.5 lakhs rupees per month after retirement. How can I do it? All those things will be possible for you if you avail for these financial planning services through us and Wealocity. And once you've done this, you've made your financial plan, you'll obviously want to start investing in various asset classes. You may want to invest in mutual funds, you may invest in bonds, real estate, or various other instruments, because you want to avail of those gains which are as a part of your financial planning exercise. And so here we can do two things for you. You can either do it on your own, go and invest in a mutual fund yourself, go and invest in your bonds yourself, or Wealocity can help you and manage your assets. They will invest for you, they will give you reports, they will continuously monitor your portfolio for you and help you see that you maximize your returns depending on what your particular objective is. If you wish to reach any of these people, you can obviously reach out to me directly by contacting me. My email is contact@moolahforwomen.com, and that's my phone number. So if at any point in time you are interested in availing financial advisory services where you want to curate your own portfolio or plan your own finances, then do reach out to us for that. And so, yes, happy investing. Thank you so much for all your time. And I hope this was useful. I have put in a review form on Google, on the chat. If you can all please share your review about today's webinar on the Google review, that will be really helpful. And yes, happy for you to ask questions. Yes, Neha.
Yeah, I have one question. Like, if I have paid some amount in the whole year to income tax, like let's say for whole year I have paid 50,000. So if I want to get that back, so if I invest only that 50,000 in something else like ATC or something, so then that whole amount I can get back.
Okay, so you have to understand that if you see the slabs, so for instance, if you were to get into a 20% slab, so which means that you save 1 lakh, it is 20%. So only you can save 20,000. I mean, you can tax save only 20%, right? 20,000 rupees, not the entire 50,000. So, okay, I'll just, to make it less complicated. So one part of it is tedious. The understanding is that if I am assuming you are an employee, a salaried employee, Okay.
Yes.
So you must have declared, they would have asked you to declare, would you wanted to do some savings? And you have declared that you would do it. Have you?
Yes.
Or yeah, but
You
have
made
you done that?
make certain investments under ATC, or have you given some declaration that you're going to make some investments under ATC, Neha?
Yes. Yes.
Okay.
Okay, so in ATC, the beauty is that you have your PF is also added. So it is an involuntary thing which gets deducted. So that also gets added to your ATC in which ways. So now you need to see what is that additional possibilities that you have declared and not done. You can finish that and claim that money. At some point of time, there could be a higher deduction than you are supposed to have done, or you would fall short. Either which ways, but they have already deducted 50, but by saving you could manage only say 30,000. You can still get that 20,000 in your ITR. So that is when you file the returns. So that will happen post 31st March. Once the financial year closes, which is 31st March, from there you have 3 more months before which you will have to file the taxation. So where you will say that this is what I've earned, this is what I have saved, this is what has been deducted. And now I am eligible, I am supposed to be only deducted, say 30,000, but there is a deduction of 50,000. So now, please return that 20,000. I mean, you don't write a mail or something, but once you file it, it is understood that there is a higher money deducted than you were supposed to, and you would receive it directly to your account.
So
I don't know if
Neha,
I have answered you.
So Neha, let me, thanks, Naresh. Let me just clarify, because I understand Neha a little bit more. She's a part of my tribe. I'll explain it to her a little bit more, simply, if I may say so. So Neha, you've already paid 50,000, or 50,000 has already been deducted as taxes by the company, right? Now what happens is that, first of all, your question when you said if you invest 50,000, will you get your 50,000 back? No, there is no direct correlation that if you've invested 50,000, you will get your 50,000 of tax back. No, that's not the way it works. The way it works is that you have paid tax of 50,000. Now, when at the end of the year, you calculate all your, suppose you've already made deduction, you've, under ATC, you've invested 1,50,000, under NPS, you've already invested 50,000, you've made certain investments under various categories, right? Now, either it could happen that you've already made those investments. If you've already made the investments and your employer has taken into account these investments, and then your 50,000 is getting deducted, then probably you will not get your 50,000 back, because they've already taken into account that all these deductions have been done, and still Neha's salary is such that 50,000 will need to be deducted out of her salary. However, if certain deductions, you haven't made these investments right now, you haven't told your company that you've made these investments, or there's certain more deductions that you can avail, which you have not told your company. And so they've deducted more tax, and that's why 50,000 has got deducted. But actually, your tax should have been only 20,000. So when you file 3 months later, generally in July, there is like we said, there is an ITR form which each of us has to fill. That's the time they will see that what is your total taxable income, what are the deductions up to which you are eligible for, which you've made until March 31st. And let's say your total taxes at that time came to only 30,000. But you have paid 50,000. Then you can ask for a refund at that time through that ITR form, that listen, I had to pay 30,000, but 50,000 has got deducted from my account. So only 20,000 you have to refund back to me. Once the ITR form is submitted to the income tax authorities, they will look and say, oh, we've deducted 50,000 for Neha, but actually her eligibility is that she had to pay only 30,000 of tax, and we agree to what Neha's ITR statement is. So they will refund your 20,000. Okay, so that calculation happens at the time of ITR filing, when the tax authorities check what you have actually earned and what are the investments you've made versus what is the tax that you have paid at that time. But For you to be able to get that 50,000 back before March 31st, sit with your tax consultant and see and check that can I in some which way make some more investments so that I can get a part of my 50,000 back. Have we clarified? Is that making some sense, Neha?
Yes, Mika, I
Uh,
only have one question. This refund that we claim from the government, is it only for the current financial year or we can claim for the years gone by also?
So
We can, there is right now only up to 2 years, you can file a revised taxation. So basically, once you have filed, it is understood it has been settled. But you have either forgotten some bits of information or something where you have to do a revised filing. Earlier, the revised filing used to be for quite some time, like 5-7 years, but now it has been reduced to 2 years. You will have to make a revised appeal. So ITR revised
Like,
is what
for
you will have to
example,
do it.
Okay, I'll just give you an example. For instance, like when we applied for a home loan, because the possession hadn't happened, so it was told to us that we can't apply for a home loan rebate. Now, after say 7 years or 8 years, the possession has happened. All the interest which I have paid for the last say 7 years or 10 years, can I claim it?
No, that's what I said. The revised, you can go up to only 2 years. So you can go back to up to 2 years and make any revised claims and wait for their. I mean, you can always make a claim for that.
So, Abha, to answer your question,
Yeah.
before the 2 years, so even if you've paid interest before the 2 years, you will not be able to get that back. For the interest that you paid last year, and for the interest, especially if you paid for the last financial year, you will have to file a revised ITR saying that this is my ITR which should have been because I did not claim interest. So now this is the actual amount of tax which I should have been deducted, but the deduction has been more because I did not avail of the interest refund. And you have to again file it, which they will have to accept. If they accept the revised ITR, then they will refund you the balance tax. If they don't accept it for whatever reason, then they won't refund you. For this year, you can definitely ask for the refund. You can put it as a part of the amount of interest you've paid. You can ask for a deduction for that as a part of the ITR form, which you're going to be filing in July.
Sure, thank you.
Any other questions from any of
Is there is any upper limit for house interest?
Yeah, so you can only claim up to 2 lakh as interest towards housing loan.
Okay, there is no deduction for the premium. I mean, actual money only for, it's like a education loan only for interest.
Only for a higher education loan, you can claim the entirety of it.
Okay.
On the education loan, you can claim on the entire thing, but on this, you can
Entire
claim
interest.
Interest here, you can claim up to only 2 lakhs of interest for the
When
whole.
you say higher, what do you mean by higher?
Higher education, yeah, it is graduation and above.
Okay, so after 12th, whatever you claim, whatever money you spend on education, all right.
No,
Interest,
not
interest
education.
on the loan. If you've
Yeah,
taken
Education loan.
Yeah.
Yes, the loan that you've taken, be it for an Indian university or an overseas university, any university. Okay.
Anyway.
All
But
right.
here, generally, it is for the individual who is availing the loan. In the sense, the student would be getting, not the parent. You have to understand that.
But the student is studying, and the student.
Yeah, so his outflow only starts after he completes the study, right? Because I myself have acquired more than 20 years back. Of course, my dad has, he will be the guarantor, but I will be the one who will be availing. So so generally you have this condition. It's not immediately after the education, but 1 year post the education, they give a 1 year gap.
Moratorium.
You can start.
Yeah.
Or you can immediately start paying. It's up to but you have a breathing space of 1 year of moratorium where you need not
You start
pay
paying
the.
back yes.
Yeah,
But
your
the point is,
EMI starts.
but you're also saying that you can claim only till 2 years. You can go back only 2 years.
No, past
Yeah.
revised. Okay, So this is a new regulation that has come. So the revised claim is only, I mean, that is, as far as I know, it is 2 years. Yeah.
So, what Naresh is trying to say is that in case you've taken a student loan, suppose your daughter has taken a student loan, right? Then generally there are two options she gets. She could either start paying the interest from right now, the moment she takes the loan, or she could start paying the interest once she starts earning. They give a moratorium 1 or 2. So once she's finished college, let's assume 1 year later, she'll be able to start paying the interest. They give that moratorium that once you start earning, you can pay the interest, right? So
No, it doesn't work like that. The moment the bank releases your amount, whatever that amount is, part payment, full payment, you have to start paying the interest from that day. The principal
Principal
amount,
repayment
yes,
happens
that will
only
get
when the
deducted
EMI
after
starts.
the moratorium of, say, a year or two. But the interest we are already paying.
right. So in that case, because your daughter is not earning right now, she will not get the interest. She can, since she's not getting any money, she can't claim any interest, right?
But my
tax.
only question is that she was working before she left. So her ITR in any case will be filed. So if her ITR is to be filed, will she not be able to claim this?
But if she's earning, she can. But if she's earning more than 5 lakhs, right?
No, did she? No, it's nothing to do with. No, did she file
anyway, she's not
even
paying
when
taxes
she was?
there, huh?
No, she was filing an ITR. See, last year she filed an ITR. Now, obviously, because
no, when she filed an ITR, is she claiming an income?
Yeah.
Look, this is, has she claimed an income? Then she can always claim this as a deduction.
Okay,
Is there an income for her?
This year she won't be able to claim an income because she's not earning.
Yeah, so you can revise last year's.
Okay, anyway, I don't think so. See, last year the interest started this year.
So this year she's not earning, she can't do anything about it.
Then she cannot do anything.
She starts earning
next year. When she starts earning, then she can claim for 2 years. Yes, that's
I don't know whether she can claim for the last year, because each year thing gets over in that year. That year's interest.
No. You can claim. If I'm not wrong, you can claim.
That is what he said. No, you can go back 2 years, and you can claim.
Okay, when I meant by 2 years, it is not that you club for all the income into or all the expense into this. For that financial year, if you have claimed, you can revise for that financial year. So, but you are saying that the past year there is a zero income. So how will you recover? There is no tax outflow, right? If there is a tax outflow and there is a negating interest that you can, then you will ask for a refund. But if there is no tax outflow, what will you ask for a refund? The government has to deduct a tax. And then you say, I have a tax saving, which I didn't claim. So I'm revising for a tax saving. But if there is no deduction by the government as a tax, you can only ask for a refund of tax, not refund of your interest.
Okay, understood. So maybe next year.
It's only refund of tax. Yeah. So each time there is a tax that the government deducted, you can ask for a refund of tax, not for the refund of interest income.
Sure.
Yeah. So that is, yeah.
Thank you.
Thank you everyone for your time today, and thank you so much, Naresh. I hope this session was useful. I hear from some other people who've already left that they found the session very useful, and I hope that you've all become a little wiser in filing your taxes this year, and it's given you some more clarity. Do reach out to us if there is something we can help you out with, either in your tax returns or your financial planning. And of course, please fill out the review form which has been mentioned in the chat box about how today's session went. And thank you so much, Naresh, for your time. And thank you, lovely audience, for being here today. And have a good rest of the Sunday.
Thank you, everyone. Thank you very much for joining us.